Ready to ride some market waves?
Less.
Today we're diving into the world of trend following, and no, it's not about predicting the market.
That's right. It's about identifying and capitalizing on existing trends.
We'll be taking a deep dive into Andreas Klanau's Following the Trend to break down this often misunderstood strategy.
It's a strategy that, at first glance, seems almost too simple to be true.
Exactly. Buy when things go up, sell when they go down. But Klanau doesn't shy away from the nuances, and neither will we.
No magic formulas here.
So let's start with the basics. What exactly is trend following?
You see, most people think about trying to time the market, to buy at the absolute bottom and sell at the absolute top. Trend following flips that on its head.
So instead of trying to be the smartest person in the room, you're kind of joining the party a little late.
That's a great way to put it. Imagine a party in full swing. A trend follower isn't the first one there. They're not even worried about being the last one to leave. They show up when the energy is high, when the trend is clear, and they slip out before things get messy.
Okay, I like that analogy. Joining late, leaving before the cleanup crew arrives. But why focus on futures specifically? Why not stick with the stock market?
That's a key question, and it gets to the heart of why many investors are drawn to futures. The traditional buy and hold approach for stocks has its limitations. Don't get me wrong, the stock market tends to go up over the very long term.
That's what they always say.
Right.
Yep.
But if we look at something like the MSCI World Index from 1976 to 2011, it gained over 1,300%.
1,300%. Sign me up.
Oh, hold on. That impressive gain translates to about an 8% annual return. Not bad, sure, but here's the catch.
There's always a catch.
To achieve that 8%, you would have had to stomach a 55% drawdown at its worst point. That's over half your investment gone. Poof.
Yeah.
Almost like going back 7 years in terms of performance.
Ouch. That's a serious reality check. Okay, so how do futures change the game?
Futures offer a couple of key advantages. First, diversification. You're not limited to just stocks. We're talking agricultural commodities, things like coffee, cotton, even live hogs. There are metals, bonds. It's a vast marketplace.
It's like a supermarket of assets.
Exactly. And that leads us to the second advantage, the ability to go both long and short.
Ah, so you're not just betting on things going up, you can profit when they go down too.
Precisely. Remember our party analogy. Futures let you ride the wave whether the market is heating up or cooling down.
So it's not just what you trade, but how you trade it. And this is where Klanau digs into the core of those professional trend-following strategies. What makes the pros tick?
And what he argues is that most professional trend followers actually utilize a very similar approach. There's no secret sauce, no crystal ball, but rather a set of key principles they stick to.
All right, I'm ready to unlock the secrets. What are these core principles?
First, you have to remember the diversified investment universe we talked about. Can't overstate its importance.
Got it. Spread the love across those assets. What else?
The second principle revolves around something called volatility parity when deciding how much to put into each trade.
Volatility parity sounds a little intimidating, I'll be honest.
It's less about complicated math and more about common sense risk management. Imagine you're working with, say, $1 million, and you're comfortable risking only a tiny fraction, let's say 20 basis points on any given trade. That's $2,000. Volatility parity helps you figure out how much to invest in different assets based on how much their prices tend to jump around. So even though my risk is capped at $2,000 per trade, the amount I actually put in will vary depending on how volatile that specific asset is. Like, I'm going to be more cautious with a roller coaster than a merry-go-round. Exactly. It's about balancing your risk across all those different assets in your portfolio.
Makes sense to me. But I'm guessing there's more to trend following than just the mechanics of it all, right?
You're absolutely right. Klanau is a big believer that understanding the psychological aspect of all this, how it feels to manage this kind of strategy in real time, that's just as important as the technical stuff.
Right, because it's not always going to be sunshine and rainbows in the market. There are going to be times when those trends fade, when you start to question everything.
And that's where things get really interesting. Because trend following, like any strategy, has its good times and its bad times. And Klanau doesn't sugarcoat that.
Refreshing, isn't it? No hype, just real talk.
So let's talk about those good times and bad times. Where do we even begin?
Well, he talks about those high interest rates back in the 80s and 90s as being a sort of free money era for trend followers.
It's free money! Now, those are words you don't hear every day. Tell me more. Imagine this. Even the cash you weren't actively trading was generating a solid return, often 5% or more, just from interest. And as those interest rates slowly declined, bond prices trended upwards, creating this incredible opportunity for trend followers to, you guessed it, ride that wave.
Sounds like the good old days, but I'm guessing those days are long gone.
Sadly, yes. The current low interest rate environment doesn't seem to be changing anytime soon, so can't rely on those free money returns to reappear magically.
All right, no more easy money from interest rates. Makes sense. But trend following has survived for decades, clearly. It's about more than just riding the coattails of high interest rates.
You're getting it. And this is where that ability to profit from both upward and downward trends, remember those short positions. That's what makes trend following so resilient. For instance, during those rough equity bear markets of 2008 and 2014, while many investors were panicking, trend followers who were positioned correctly, those with strategic short positions, they were actually generating what's known as crisis alpha.
There's that term again, crisis alpha. It sounds almost too good to be true. Profiting when everyone else is freaking out. How does that even work?
It's about recognizing that market turmoil creates opportunities. Trend followers aren't afraid to profit from a downturn. When things go south, and they inevitably do, those short positions act as a sort of counterbalance, a hedge against losses.
So while everyone else is running for the exits, trend followers are in a position to potentially benefit.
Exactly. It's not about predicting the future. It's about being prepared for different scenarios. Up, down, sideways trend following is designed to adapt.
Okay, starting to see the appeal here, but let's dig a little deeper into the nuts and bolts. Klenow goes beyond just the basic trend following strategy. He talks about tools like counter-trend trading and a rather mysterious concept called term structure, right?
He does. Think of these as ways to potentially fine-tune your approach, to enhance returns or manage risk even more effectively.
All right, break it down for me. First up, counter-trend trading. It sounds counterintuitive, doesn't it? Like fighting against the very trend you're trying to follow.
I can see why you'd say that. But let me explain. Let's say you've identified a clear uptrend. Counter-trend trading, in this case, would involve buying during those temporary dips or pullbacks within that larger uptrend. And vice versa. In a downtrend, you might consider shorting those brief rallies.
So it's about taking advantage of those smaller waves within the bigger wave.
Exactly. You're not trying to outsmart the market. You're simply fine-tuning your entry and exit points for potentially greater returns. But Klenow is very clear that this should always be done in alignment with the overall trend, never against it.
Don't fight the current, go with the flow.
Got it. Now let's talk about this term structure. What's that all about? Term structure might sound complicated, but at its core, it's about understanding the relationship between futures contracts that have different expiry dates. You see, a futures contract for, say, gold that expires next month might have a slightly different price than a gold contract expiring 6 months from now.
Okay, so same asset, different delivery dates, slightly different prices. Makes sense. But why does that matter for a trend follower?
Because these price differences, known as contango and backwardation, can actually give us clues about market sentiment and potentially even help us identify trading opportunities.
All right, hold on. Contango and backwardation. We've got to unpack those terms because I'm pretty sure most people listening have never even heard of them.
You're probably right. In the simplest terms, contango is when the futures price of an asset is higher than its current spot price, that is, the price you'd pay for immediate delivery. Backwardation is the opposite. The futures price is lower than the spot price.
So if I'm understanding this correctly, contango suggests that the market expects prices to rise in the future, and backwardation suggests they might fall.
You got it. And there are various reasons why contango or backwardation might occur. Things like storage costs, supply and demand dynamics, even market sentiment can all play a role.
Fascinating stuff. It sounds like understanding term structure as a whole other layer of analysis to the trend following process. It's not just about charts and technical indicators, it's about understanding the bigger picture of supply, demand, and market psychology.
Precisely. And Klenow provides a deep dive into how to actually use contango and backwardation to your advantage in his book. But for now, I think the key takeaway is that these seemingly complex concepts can provide valuable insights for any futures trader.
It's all starting to come together now, but let's bring it back to the individual listener for a moment. We've covered a lot of ground here, but the big question on everyone's mind is this. Is trend following right for Hemi Win?
The million-dollar question. And Klenow is very upfront about this. Managing expectations is crucial. Trend following isn't a get-rich-quick scheme. It's not a magic solution to all your investment woes.
So no promises of Lambos and yachts?
I'm afraid not. Honesty is paramount here. While trend following has the potential for significant returns, it's essential to approach it with a healthy dose of realism.
All right, so level with me. What are the potential downsides? What do I need to be prepared for?
For starters, you got to factor in trading costs. Those brokerage fees, those exchange fees, they can add up over time. Then there's slippage. Remember that gap between the price you see on your screen and the price you actually get when you execute a trade? Well, that's slippage, and it can eat into your profits if you're not careful.
So even small costs can make a big difference over time. Got it. But those seem manageable. Is there something bigger that trips people up when it comes to trend following?
The biggest hurdle, the one that trips up most traders, is the psychological aspect. Managing your emotions, having the discipline to stick to your plan even when your gut is telling you otherwise, that's the real challenge.
Right, because it's easy to get caught up in the heat of the moment, to second guess yourself when the market throws you a curveball. And speaking of curveballs, Klenow ends with a rather provocative thought, something that seems counterintuitive to everything we've learned about investing.
He says one of the best times to invest in a trend-following strategy might actually be after it's had a string of losses, not after a winning streak.
Wait, really? That's wild. It seems like everyone's always chasing those hot strategies, those recent winners. Why on earth would you jump in after a strategy has been struggling?
It all goes back to understanding how human psychology plays into the markets. When a strategy has been performing poorly, investors tend to get spooked.
They get cold feet.
Exactly. They start doubting the strategy, they pull their money out, sentiment plummets.
Fear and uncertainty take over.
And that's precisely when a contrarian opportunity might be emerging. If the underlying strategy is fundamentally sound, those periods of underperformance, they often create a scenario where the strategy becomes undervalued, potentially setting the stage for a rebound.
So it's not about chasing past performance, it's about recognizing that those periods of struggle, as counterintuitive as it might seem, can actually present some of the most compelling opportunities.
Exactly. It's about tuning out the noise, ignoring the herd mentality, and trusting in a process.
That's a powerful concept. It reminds us that sometimes the greatest opportunities emerge when everyone else is running for the hills.
Couldn't have said it better myself. And that, in essence, is what Klenow wants us to understand about trend following. It's not about predicting the future. It's not about finding the holy grail of trading strategies. It's about having a disciplined approach, managing risk effectively, and having the courage to stick to your plan, even when it feels like everyone else is losing their heads.
That's a fantastic takeaway. It's about having the confidence to be a contrarian, to see opportunity where others see only fear and uncertainty.
And to remember that no strategy, no matter how well designed, is immune to periods of drawdown. It's how you respond to those inevitable drawdowns that will ultimately determine your success.
Couldn't agree more. Well, there you have it. We've journeyed into the fascinating world of trend following, guided by Andreas Klenow's insights. We've explored the underlying principles, the potential rewards, and the absolute necessity of managing risk effectively. And perhaps most importantly, we've learned that sometimes the best opportunities are the ones that others have overlooked, those hidden gems that reveal themselves only to those brave enough to think differently. So until next time, keep exploring those uncharted territories, keep challenging those conventional wisdoms, and as always, happy trading.